everybody wants to minimize their income from a tax standpoint because you pay less taxes. But what that does when you go to apply for a loan, it makes it look like you don't make anything because you're trying to make it look like you don't make anything, so you don't have to pay taxes. So
it's a double-edged sword.
Right. So as we all know, the biggest obstacle to buying your first home or any home is getting the money. So we have a treat for you today. We have one of the top mortgage lenders in our area, and she's going to share with us some of the hacks that will help you get a home. Our special guest is a good friend of mine, Jenna Whitmer. She's with First Access Mortgage, and if that sounds familiar to you, it should, because they are our title sponsor for the whole podcast. And thank you very much for that, Jenna. We appreciate you being on the show.
Thank you for having me.
Yeah. So, and you know this, but on the Will Frederick team, our real estate sales team, they are our number one lender, and Jenna is a huge resource. We'll call her all the time with like, hey, even if it's another lender involved that, we didn't get to her first, it was like, hey, what is this going on? Like, do we need help with this? Does this sound fishy to you? So Jenna's been a great resource to us. We highly recommend them to all of our clients. So, and the reason I'm excited to have you on the podcast today, Jenna, is because I consider you such a wealth of information. And I wanted to tell the audience how you got your start. So why don't you tell us a little bit about your background?
Well, I've actually been in the lending world my entire career, from at a very young age working at a finance company to moving up to a bank and offering home equity loans and lines of credit, personal loans, auto loans, credit cards, all of that.
Yeah, I got to know Jenna when she was still at Capital One, just walking into the bank and getting to know her. So
yeah. And look, I'm telling you, that's honestly how far we go back is from lending.
Years.
So one of the things that, I really found to be passionate about lending is that there's so many different types, and it's really hard to find someone who knows all the different types and not just their need. The one thing that I didn't do was mortgage. So when the banks started to step out and phase out their lending programs, that's when I decided, what can I do next? I kind of got a little bored. So I said, well, I don't think you can get bored in mortgage.
No, you can't.
Was I right?
Yeah. It's never a dull moment. It's always something new,
never.
Right? Yeah.
Correct. So here I am 5 years later. I've been with First Access Mortgage. I truly enjoy it. I find it still today I'm passionate about what I do.
And at the volume of business you do, 5 years, in this realm is probably more like 10 or 15 with other places because of how much business you do. I know you've untangled some pretty complicated knots for us.
Yeah. It's always interesting. I'll tell you that.
Yeah.
You never know what you're going to get.
Yeah. Well, but you know how to navigate those things. And so we appreciate that. So I don't want to get too much into the weeds of that today. What I'd like to do is, we promise our audience some financing hacks. So I want us to go through walking us through the basics of getting finance for a home. Like, where do you start when it comes to, hey, I want to buy my first home, or maybe I want to buy my next home? What was the first few things you would tell a borrower to do to get prepared?
So the first thing is really a conversation with a loan officer, a lender.
Yeah.
And that is just to create your picture, to see what you're looking for. Are you buying your first home, your second home, an investment home? And at that point, we would then say, okay, well, let's do an application. An application is going to look at your employment history, your credit report, your assets, which is your funds in the bank, your debts, which you owe on credit, and your overall financial picture. And why I said just a phone call is going to be because everybody's situation is different.
Right. You want to find out what they're after, what their goal is.
I don't want to just jump in and pull your credit when you don't even work.
Right.
So, and that's as simple as, hey, we need a 2-year job history. Or, hey, I just graduated college. So I've never worked before. How would I even qualify?
Right.
And that would lead to a conversation of, okay, well, did you graduate? Do you have a degree? We can use that schooling history as your 2-year job history. So, and a lot of people are just baffled by that because
they don't realize you can do that.
Yeah, when they've never worked, never received a paycheck in their life. So
and that's what I want to highlight, because I think having conversations with you opens up doors for people that they didn't know were possible. Like, they think, there's no way I can qualify. But if you talk to Jenna, she knows so much about so many different programs. There may be a program that you can fit into, and she has that knowledge.
Right. And the best thing about it is, we don't consider ourselves advisors in any way. That's a whole different job title. However, we are people who have experience in this business that can tell you what you need to do. We can pack you with the knowledge and the power and the tools and the tips to get yourself where you need to get yourself, whether that's doing an application today or doing an application in 30 days.
Mm-hmm.
So that's the most important thing, is call and talk to me.
Right.
I'm a real person. I have went through real life experiences too. Don't be ashamed of anything. Tell me, let me help you through it.
Exactly. And that's what I tell people, like even in counseling through real estate stuff, the more you tell me, the more options we're going to have.
Correct.
Because there may be something that they're not telling you, they're holding back because they might be embarrassed about it or think it might tank their deal.
Correct.
And if they hold that back, there might be something that if they told them that to you, you would be like, well, we can't do this program, but that opens up this whole program and it could be a better situation. So the more information, the better. Am I right?
Correct. It's funny, when back in my Capital One days, we had a district manager that would make us have this profile sheet. I know that sounds terrible, but it was a profile sheet and it had all these boxes.
Yeah, you probably have to be careful about that these days, but you probably have to call it something different.
And what I mean,
I know,
profile is, it was a personality profile, and it was like a goal profile for what this person wanted out of their relationship with the bank at the time. So it's funny that today I still use that sheet in my brain to say, okay, the minute I start talking to you, what is this person looking for? Is it their first house?
Yeah.
Is it their second home? Is it their investment property? Is this, what does their family look like? What size are they going to need? That kind of thing. So it's I guess I shouldn't call it a profile sheet anymore. I should call it, just the learn about your client sheet.
Yeah.
So,
well, and I think, and I've often said this about sales, because sales gets a bad rap sometimes because people are trying to push the product down their throat. But what our most valuable asset and our most valuable skill that we can offer to our clients is, I say, you have 2 ears and 1 mouth, and you should use them in that proportion.
Yes.
Which is hard for people like Jenna and I, because we're like
talkers.
to talk.
We're talkers.
But we've learned to listen and hear what our clients say, ask questions, and then listen. Go a few questions deep, right? I mean,
that my grandpa used to say, if your mouth's open, your ears are closed. So sometimes you have to close your mouth, open your ears, and listen. You can gain so much valuable information by just listening, and that's what I was trying to say with that, is that I want people, I listen to, like you said, listen to what they say, and I may be able to recommend something that they don't even know that they needed.
Exactly.
So
you're the expert. You have this wealth of knowledge and all these, this portfolio of programs that they don't know exist. They think it's just like one size fits all. Well, it's totally not.
Yeah, and then there's times that I'm like, hey, I don't have this, but this is what you're looking for. And as long as I've been around lending, and I typically can say, this is where you can find it. So it's having a big referral bank of people to say, okay, this is what you need.
And that's, by the way, how you know she's a quality character person, is because she's not all about just getting you, the deal that she has for you. She'll tell you if she's not the best deal. And it doesn't happen a lot, but you and I were talking the other day about a HELOC, and you're like, well, based on what you want, that, we might not be your best option.
Right.
I know we talked about, some of the basics of getting started, and application sounds like it's the place to start, because that opens up the doors to lots of different things, right?
It does. An application is very intimidating on paper, which is actually why I like to do it over the phone. It could be a little intimidating, but what we're looking for on an application is a 2-year job history. It doesn't have to be with the same employer. It doesn't have to, you can have some gaps. We have to create a 2-year history of working. When a bank is going to lend money to you, they want to know that you have the ability to pay it back. And that is by having income.
Right.
So it's a very vital piece of the application. The next thing is how you pay back the things that you have borrowed in the past or that have currently have borrowed. So we look at your credit history on your credit report to get a good picture. I know everybody focuses on credit scores, but a lot of times it's not the credit score that.
Yeah, that's not the only thing.
It's not. I get a question all the time. Can you do a 580? Yes, I can do a 580. But why are you a 580? Because if you're a 580 because you just missed 2 auto loan payments in the past 12 months, that can be an issue. So that's why I tell people all the time, let's have a conversation. Let's see where you are. And then we could decide if I should pull credit at that time.
Right.
But honesty is the most important thing, because I don't want to pull your credit if you're not really there.
Mm-hmm.
So,
well, and sometimes we even had a deal with you recently like this where we knew what a borrower had an issue with, and you said, hey, listen, if they do X, Y, and Z and pay this down a little bit and do this, that's going to bump up their credit score and it's going to make everything fine.
Right,
you know?
right.
And you counsel people through those kind of situations.
That's right. That's right. So when, if I think, or if we're not on the fence about something, I'll say, hey, look, let me put my hands on it, which means let me pull it, let me touch it. You know, where your score is right now, it's iffy. Or your history that you just told me, it's iffy. So let's take a look at it. And at that time, I can actually sit there, analyze it, simulate what your score is going to do, what you can do to get where you need to be. So credit history is another huge part of the application. The next thing would be assets, which is actually bank accounts, investment accounts, money. That came from an acceptable source.
Yeah.
So, and typically that would look like a checking account, a savings account. It could be a certificate of deposit, a CD, mutual
something
fund.
They call seasoned, which means it has history. Is that
right? For right now, typically, yes, they look back 2 months. So when I say bank statements, the last 2 months bank account statements.
Gotcha. Okay.
And then retirement statements, things like that.
So I've heard it put the 3 C's: credit, collateral, which is the assets you're talking about, and then capacity, which is the ability to pay, the income.
Correct.
Right? Okay.
Yep.
Cool. Yeah.
Yep. So credit is your credit report.
Right. That's pretty
collateral would
straightforward.
be what you're borrowing on, which mortgage is kind of a no-brainer. It's the house. And then capacity is, are you able to pay this back? Does your credit show that you have a history of paying your bills? Okay.
Because I think when a bank is looking at a borrower, a lot of times you feel like the underwriters, which is the back end of Jenna packages up your loan information and sends it up to the underwriters. It's almost like the underwriters are trying to shoot holes through it and try to prove why we shouldn't lend money. But Jenna is your advocate, where she's saying, no, look, they can do this, they can do this, they can do this. She's presenting your case.
Yeah, I'm
so
your
the
middleman.
more she knows, the better, because she can kind of say, give this information. Let's not tell them about that, because that's a little bit of a red flag.
Right. So I always say we got to paint a picture. It is my job to work with you to change their mind.
Exactly.
Okay.
And Jenna's very convincing. If you haven't gotten that vibe already, you can
Persistent,
see. Yeah, that's really good stuff. That's exactly what you want in a loan officer. So.
Yeah. So, and then your debts is the other piece that's of the application. So when we say debts that are on your credit report or that you're court obligated to pay. So, credit report would be credit cards, installment loans, auto loans, mortgages. And then you have collections, which that's a whole nother ballgame. But then you have child support, alimony, equalization payments, which is something I just learned recently.
What is an equalization payment? I have not heard of that.
It's where you owe amount of money for divorce to your ex-spouse. However, you don't have the funds to pay it, so they set it up in installments.
Okay.
But it was something new that I learned.
Okay. So it's sort of like a child support alimony, but it doesn't have to do with kids.
It's an obligation, though.
Yeah.
It's a court-ordered obligation. Yeah. So your debts are going to be your items listed on your credit report, and then anything else that you're court-ordered to pay. Okay. So a lot of people come and they're like, well, my cell phone bill is this and my, that, et cetera. Well, that's not anything. That is why the underwriters they don't allow you to lend 100% of your income, because there are other debts that you cannot see on your credit report. They're just the only ones that actually report to the credit report every month. So.
Gotcha.
Yep.
Well, I want to take a fun little detour for a minute, because I know you and I have talked about this. There's a lot of crazy things we see in this business.
Yes.
And I want to hear a fun story about maybe like one of the craziest situations you've ever had, or maybe like a deal that you had to rescue. You got it and it was a mess and it was already and they decided to switch lenders and Jenna came in and saved the day. If you have any examples of something like that, those are always kind of a little fun. And you get to flex a little bit as your expertise. You're like, man, I did this and I did that and it was wild, but we made it happen,
Oh, man. I think my favorite one, being in this business a while, there's a lot of them. Between rescuing from another lender or just something popping up in the middle of lending that I couldn't have seen coming. But and that's really my favorite one. Was I had to make somebody get married.
Wait a minute, what? A shotgun wedding?
I had to make someone go get married. So it was actually a VA loan. The wife was the veteran. And the whole time she's referring to him as her husband. However, let me say that I stepped in the middle of this. We had an originator go out sick. And so I stepped in to get the deal closed. Of course, it was at contract date. Everybody was screaming. I mean, it was a nightmare. So had to jump in, rescue the day, So I'm like, okay, at the time she worked for, funny enough, a bank
Uh-huh.
that they were receiving COVID pay.
Uh-huh.
The originator that had originally handled the file didn't realize that her pay had COVID pay in it. So like the bank they were paying them an extra $5 to $10 an hour.
Oh, wow.
Yeah, so it was significant.
Yeah.
But it wasn't going to continue for 3 years, which is a big rule in mortgage.
Mm-hmm.
So they,
All of a
brought her
sudden,
income
cut her
down.
income.
Yeah.
Sure.
So then I'm like, okay, how do we fix this? And I was like, okay, what does your husband work? She's like, yes, his score is not the greatest. And I'm like, well, what is it? And I looked, I'm like, okay, we can still make that work. So we turn around and I'm like, okay, well, I just need, y'all's names aren't the same. So they're going to ask me for a marriage license. So go in. And she's like, well, actually,
wait a minute.
Actually, we're married in the eyes of God, but not legally on paper. So, but which probably wouldn't be an issue. It's not a requirement to be married unless you're doing a VA loan.
And you have to have that income but I guess that's other lending programs. You don't, you can combine incomes, but VA, wow.
Yeah.
Interesting.
So, they were like, look, we had a ceremony already. If you tell us we have to go get married, it's not a problem. Like we never filed the papers because life and I think she said his mom passed shortly after their ceremony, so they just
didn't file the papers.
Grief-stricken,
right?
yes. So she's like, and it's been like 10 years. So she's like, that is not a problem. So literally, they ran to the justice of the peace, got married. Gave me the certificate. I added him to the loan, saved the day. I had to add him not only to the loan. I mean, it's a lot more involved than that. It's add him to the loan, the purchase agreement, the appraisal. I mean, title work. It was all that.
So we can add matchmaker to the list of your credentials. Then I guess.
It was fun.
That was fun.
It was fun. The only thing I could say is I was very excited that they were already married.
Sure, yeah. It wasn't like a
religious
false,
or a capacity that they were okay with.
They were really married. Yeah.
And I've had another client that I've mentioned that to, and she's like, "Well, we have 3 kids together, so getting married is not an issue."
Right,
so I actually haven't seen anyone. Had someone else not really, be adverse to it, but it was like I said, only a VA loan is going to require that.
Okay. Cool.
So
for somebody that wants to get qualified for a loan, whether it be the first time or another house or a vacation home or something like that, what's the number one piece of advice that you would give to them? And that's kind of a broad question, but is there something that pops out and thinks, wow, this is the most important thing?
Well, when I first talk to somebody, I say, hey, do you know where your credit score is? Whether you're first time, second, it doesn't matter. Do you know where your credit score is?
Yeah.
Typically they will, because there's so many credit monitoring companies. And they're free, and a lot of your current creditors may already offer them. And so, but the biggest thing is monitor your credit. I can speak from experience. My husband just got a bunch of letters in the mail saying he applied for credit cards. And I'm like, really? You applied for credit cards? And he's like, no, I told you I had a bunch of weird emails and I thought maybe I was getting hacked. And, and he had been a victim of identity theft before.
Oh, wow.
So monitor credit because it can be as simple as an error. I can't tell you how many people I've pulled that have 1 780 credit score, but 2 650 credit, because there's 3 credit scores.
Right, yeah.
We use the middle. Okay. So if you're a 650, 660, 670, I'm going to use that 660 for qualifying.
Yeah.
So when you have a 780 borrower and then they turn around and have a 650, 650, that 780 goes to a 650. And it's as simple as a $25 medical bill that they never received a bill for whatever reason.
Yeah.
You could obviously tell from their credit report that they've never missed an obligation.
Right.
And if they had been monitoring their credit,
they would have been able to take care of that early on.
And look, there's easy ways to fix that. But it takes, let's say, a week to get it done. And if you're wanting to make, move on a property quick, it's something that if you just monitored it and set up alerts, it would
then you would be fine. You're just being proactive and making sure, you're ready.
Be mortified that they had a $25 medical bill. And I'm like, okay, don't freak out. We're going to get it. So
I'd like to thank our title sponsor, First Access Mortgage. They are Louisiana's first choice mortgage lender for the last 21 years. We are super excited to be partnered with them. For your first home, vacation home, or investment property, they're truly your home loan resource. So go check them out. What are some of the myths that they've never talked to a loan officer before and they finally sheepishly come to you like we've been trying to convince them to do, and they just think something that's just not the case? What is one of the myths or a couple of the myths that they might believe about getting qualified that you're like, no, that's not at all how it is?
Probably the biggest one is 20% down.
Yeah.
I thought we were past that, but we're not.
Yeah, and that's a big thing these days. I mean,
correct.
20% is a lot of money,
It
but
is.
you do not have to have 20%.
No.
When's the last time you did a 20% down loan? I mean,
well,
I guess you do them a lot.
But
yeah,
a first-time home buyer putting down 20%,
Yeah,
even
extremely rare.
second-time home buyers,
Mhm.
sometimes even they don't have the 20%. Even if they're selling their current home, it's going to depend.
What would you say the percentage? I mean, this is a trick, kind of like a pop question, but what would you say the percentage of 20% down loans you do out of all the loans?
A year, I'd probably say a dozen.
A dozen. Out of how many loans did you do last year?
Probably 80.
Yeah. So not that high of a
100.
percentage. So
Yeah.
the reality is, it sounds like 75, 80% of the borrowers don't actually have to have.
And I've had
20%
people,
down.
when rates were great, I've had people that had the 20% down and they chose not to put it down.
Right.
Because
they
could they can invest that money into something else to make money versus saving the 3.5% interest rate.
Exactly.
So I've had that happen where they don't want to, they have the 20, they don't want to put it down.
Right. Sure.
There are the 0% programs.
Lots of those.
3%, 3.5%, 5%. Second homes, 10%.
Yeah.
Investment 15%. They have a lot of different options.
Yeah.
What I said earlier, call me.
Going
Just
back
call.
to giving you the information and saying, hey, what are my options, Jenna? Because Jenna's the expert that's going to be able to let you know what those options are.
And then another myth is going to be perfect credit. So, I just talked to someone just a couple days ago, and he told me, hey, let me go back. His significant other needs some more income to qualify for a 100% program. They have their down payment money, but having the down payment and closing would be a little tough. She said, well, I can add my boyfriend, my significant other. However, his credit isn't perfect. I said, okay. He's working with a credit repair company right now. And I said, okay, well, what does he have him repaired?
Right.
And she said, I'm not sure. She three-ways him on the phone. He said, okay, well, it's an auto, a repossession, or an auto that was totaled and it had a balance because I didn't have gap insurance. And I said, okay, well, what status is it in? And he said, I'm not sure. I said, well, log on right now and look because he used it.
Go get it.
And he's like, okay, it says it's a charge off. I'm like, okay, well, you're repairing something before even speaking to someone like me. That's not going to even affect us in mortgage.
Yeah. Okay.
Now,
cool.
What they do at credit repair is focus on getting your score up. Okay.
Mhm.
And that's wonderful. But if he had a qualifying credit score, so I'm like, look, you're holding yourself back.
Right. You just didn't know.
You're wasting time and most likely money that we could be putting into this house because you didn't consult with a mortgage advisor.
Yeah.
So a credit repair, I'm sure they do wonderful things to repair the score.
Right.
But the score, if you're already at a qualifying score,
then you don't really necessarily have to do that.
Exactly.
You can do that long term just for the proactive solutions
Right.
for the future. But hey, right now, let's not let it hold us
exactly.
back.
So I should be able to add him to her file, and they'll still be in the income limit to qualify for 100% financing, and that past indiscretion is not going to hurt him.
So I'm sure you can hear just from the way she described that situation how she has to do some, it's like a puzzle. You're putting it together.
Correct.
And just knowing all the puzzle pieces like you do really helps. All you have to do is go to her.
It does. Some pitfalls that I run into is self-employed borrowers. Self-employed borrowers, their income is generated off of their tax returns.
Yeah.
And a lot of people utilize write-offs,
Yeah.
expenses, which I don't blame them for that. I mean,
Who wants to pay taxes?
No, I wasn't going to say that, but yeah.
No.
So, however, it's really important to have income to do a mortgage.
Right.
So the best thing at that point, when you're self-employed, is to take a look, for me to take a look at those tax returns. Once I take a look at that, I'll be able to say, okay, we're okay. But also, if we're not okay, then, hey, I need you to get with your CPA and understand that you're lending and that you're going to be lending in the next 2 years.
Right.
So, because it is very important, you may choose not to write off things.
Yeah.
Even if it costs you some tax money.
Right.
In order to qualify for a mortgage.
And that's something, I'm glad you're bringing that up, Jenna, because that's a thing I've run into in the past as a self-employed borrower. At times I've had to say, oh man, everybody wants to minimize their income from a tax standpoint because you pay less taxes. But what that does when you go to apply for a loan, it makes it look like you don't make anything because you're trying to make it look like you don't make anything, so you don't have to pay taxes. So
it's a double-edged sword.
Right.
It is.
Yeah.
So that you have to be really careful with that.
Yeah.
Having a CPA that understands now, and that doesn't mean that they didn't do their job as your CPA. What that means is that you didn't let them know that, hey, before you write all this off, am I going to have any income?
Right.
And that's a conversation I have with people a lot is, hey, I need you to get with your CPA. I need you to tell them that you are going to be buying a home in the next 2 years.
Yeah.
That way they can structure your taxes accordingly and say, hey, before I file this, do you want your loan officer to look at it and see if this income figure works for you?
It's getting the team to work together.
Correct.
Now, I have a question. This could be a little bit of gray area, but can you file your taxes, get the loan, and then later on go back and amend your tax return after the loan's done to take advantage of those write-offs? Or is that kind of like you're not supposed to do that?
I don't know. I would assume.
Well, neither one of us are tax attorneys, so
we're not. No, but I will tell you this: anytime you amend, it throws red flag. So I have had someone tell me that's what they would do, but at that point, that doesn't have anything to do with me. So, but I can tell you, if you need to know about that, talk to your CPA. That
would be a good idea. Y'all know we have Bob Norton as a regular guest on the show, so you'll hear some good advice from him, hopefully on that, but you can ask him about that. Don't ask either one of us.
Because it is tricky. I mean, mortgage is tricky, like the insurance world. Mortgage, that's all these professions are key to your financial picture. If you've never been self-employed, you would wonder like, what are you talking about?
Deal?
It's just a tax person. They just file my taxes. Yeah. And the bad part is a lot of times you don't realize it until you've already filed it. And then it's trying to backpedal and figure out how to fix it.
Yeah.
So, and I just hate talking to somebody and saying, hey, I need 2 years taxes.
Okay.
Yeah. And the biggest thing I see is someone who goes from a W-2 employee to a 1099 employee. They become self-employed.
Right.
So whenever I tell them like, hey, 2 years taxes, they're like, well, that's 2 years from now.
Right.
Sometimes like almost 3 because they got to have a full, and I'm like, I know it's a little crazy, but. And
so that's something to consider before you go from W-2 to 1099. If you need to buy something, buy it now and then wait, for the next purchase another few years.
That's right. I've had clients ask me that like, hey, I have this other job offer. I'm already qualified with you. Can I take it? I'd be making more money, yada, yada. And the first thing I say, is it a W-2 job?
Yeah.
And if they say, no, it's going to be 1099. I'm like, well, yeah, you're going to make more money 1099 because they're not withholding taxes.
Right, yeah.
But you're going to immediately have a 2-year stop. Every now and then there is a little, certain loan program will allow you to have, if it's in the same
profession or whatever,
because they want, what they're looking at is they want to analyze your income because then it becomes variable.
Right, exactly.
So your continuity, exactly.
Yeah.
So then they take in this number, let's say you made $60,000 as a W-2 employee, as an insurance adjuster, and then turn around and you go do it 1099. Well, after that first year, if you're at 60, they're like, okay, well, you don't have write-offs because on W-2, you can't write off unreimbursed. So they're like, okay, well, then there is continuity of income there.
Right.
But if you turn around and your 60 goes to 20 because you had all these write-offs, they're like, oh, well, it's very important to, especially if you're already in the process. I know it's not something that people can just call me and say, hey, Jenna, I'm changing jobs and buying a house in 5 years,
Yeah.
But at the same time, if you're ready qualified or if you're even thinking about it in the next couple months, in the next year, it's worth a call. It's free to call and talk to me. If you know me, I'll talk to you.
Brought up something else that is really a big thing. We talked about some pitfalls, but there are some things that a lot of times mortgage brokers know and real estate agents know that are like, don't do these things. Once you get under contract, like don't just pause. Everything financially pause. What are some of those mortgage don'ts that you would say, do not do these things? I've seen lenders will send them out on a list like, hey, if you're thinking about this, don't do bump. Because most people don't know and they don't know what they don't know. So you've got to tell them.
Correct. They don't know what they don't know.
What would you like to tell our people?
I feel like I say this all the time, but don't open any new debt.
Yeah.
So that's huge. Mattress money. Don't deposit any money without consulting, especially when you're under contract. Most importantly, when you're under contract
to buy a house.
Yeah, right. So you're in the loan process.
Right. You're already underway.
I've had clients call me before and say, Jenna, my tire blew out. Can I go buy a tire? Because they did not want anything to go wrong, which is laughable, but at the same time respectable.
But you're glad that they're thinking about that.
That's right. Don't open new debt.
Yeah.
Don't deposit mysterious cash.
Yeah.
A big thing in mortgage is we follow anti-money laundering rules. So they don't want to have mysterious cash because they don't know where it came from. We have to be able to source it.
Right.
And that means it was a paycheck. We have a pay stub.
Right.
That means, let's say you have gift money from a family member. We can prove that it came from their bank account with a bank statement. There are times that you can make small deposits or things like that, but that's when you call your loan officer and say, "Hey."
And that's probably relative to the amount of income you have. If you're making $5,000 a month and you deposit a couple $100 in there because somebody gave you, paid you cash for, you sell eggs or whatever. That kind of thing.
Right. So what'll happen is, let's say you had $5,000 in the bank when we initially started your loan process, and then you deposit $5,000 in cash because you didn't know that it was a don't, and now you have $10,000, and you need, let's say, $8,000 for closing, and that's why you deposited it.
Right.
You did it in good faith, but so then when I get the statement to show you have enough money for closing, they're going to say, where'd this $5,000 come from? And when we say cash. They're going to say, okay, well, the $10,000 that you have, we have to unsource that. So now you only have $5,000. So then you're in the same pickle you were already in. It's just real important to, like I said, always communicate. Communication is huge in mortgage.
Yeah.
You don't know what you don't know, so ask. So.
And one of the other things we've told people before, and usually the loan officer tells them, but we sometimes double tell them, like, don't go buy furniture for your new house on credit.
Don't buy the furniture before you have the house to put it into.
Because then you might not get the house.
That actually happens.
Yeah, we've had that happen.
A car.
Yeah, a new car.
There's times that people open a credit card to boost their score, and it didn't report before I pulled the credit. So yes, that was a new credit that I ended. Then they saw the inquiry because they will see it. I mean, mortgage, I hate to say it, but they're like the FBI.
They go,
So what they'll do is make you provide a statement. Typically a credit card statement with a $25 minimum payment, or even if there's nothing on it, that's not going to kill your loan. But the $500-$600 automobile, I don't know many borrowers who can get past that in an underwriting standpoint.
Yeah.
Because it is such a huge hit to your debt to income ratio.
Yeah, the DTI ratio. That's a big deal.
Yes.
Yeah, that's your capacity to pay, that third C we talked about
Correct.
earlier.
Your debt to income ratio is a percentage, which is your gross monthly income by your debts. That's the number that underwriting, they have every program has certain numbers that you have to be at.
So usually top 45% or so.
About.
Yeah. So,
and that would be for your total debt. We also have a housing debt ratio. So that's your house note in relation to your gross monthly income. And that typically they want you to be at about 33% or under.
Yeah.
Because that gives you the additional funds that you have. Keep in mind, we use gross monthly income. So we're not using your net. We're not using the amount you're actually getting.
It's before all that.
So so that percentage is allowing for income taxes, insurances,
from groceries, gas,
gas,
all of that,
living expenses.
Right.
So that's why the income ratios are in place, because they have to allow for that.
And before you get overwhelmed with this, you don't have to know income ratios because she knows income ratios. All you need to do is give her your information. So
Okay, some hacks. So
mortgage hacks. Let's do it.
Some hacks that we use in mortgage. A rapid rescore. Are you familiar with that?
Yes, I know exactly what you're talking about, but our audience may not. So what is rapid rescore?
So a rapid rescore is basically where we can simulate some things that you need to do on credit, and you do them, and we can submit that information that you've did them. For instance, an updated statement for a credit card or a letter showing your new balance, to immediately up that score. So let's just hypothetically say we have a 580 borrower. We qualified them with a 580. However, the interest rate's not quite ideal for the 580, and the agent wrote a 45-day contract. So we have a little bit of extra time. So we can turn around, rescore the credit up to a 620 by paying down one credit card. There is a small fee involved. It can get to be costly if there's a lot of things that we're trying to rescore. But within 1 to 5 business days, we have that 620. So that's a hack that we've used a lot. And let's just say that we didn't use it in that capacity. Let's just say someone calls me and they need a 620 and they're at a 600. For, let's say they're trying to get USDA 100% financing. What they'll do is pay down the balance on the credit card we'll go and rescore it. And then boom, a week later, they can write a contract.
Okay.
So it's not having to wait, because credit bureaus take 30 days to report, and
Right.
they don't always report in a timely manner. And that's a long time to wait.
Yeah.
And meanwhile, let's say you paid that one down, but you charged something on this one, and because
Right,
that
yeah.
all can change it. So a rapid rescore we utilize a good bit in the mortgage world to boost the time frame.
Mortgage hacks.
Yep.
With Jenna Whitmer. What else you got? What else? Got any other tricks you got up your sleeve?
Hacks. One of the little tricks to the trade is, I have people call me that just graduated from college. I think we touched on this a little bit earlier. And they're like, hey, I've never worked. Your schooling with your diploma, let's say teacher, teacher degree, say, hey, I start working in August, which is coming up. So they turn around and say, okay, well, your schooling is your 2-year job history.
So as long as you have a job, you probably have to have a job offer on the table, right?
Yeah, I can use an offer letter, or you could just have one pay stub. Because some people say, I plan on waiting because I won't have 2 pay stubs until.
You're like, no, we can do that.
I'm like, no, you got an offer letter, let's roll. Non-traditional credit history. I know that's a big long word.
Yeah.
Sometimes we'll have people who don't have hardly any credit. Okay.
Yeah.
Which can be just as bad as having bad credit.
Yeah, right.
Because there is no history at
Right,
all.
no history.
So what we can do is use non-traditional credit, which is, let's say, your cell phone bill.
Rents. You can use
your
rents.
rent.
You can get with your
rent.
landlord if they don't report to the credit bureau.
Correct.
You can get a rent history.
And I can get it
have
reported.
Right.
And won't necessarily help your score. That's not our goal here. Our goal is to show that you have
some history
of paying people on time.
Right.
So that's something that we could do. That really comes into play if you don't have a score. So what we call a no score. We can say, hey, no score. However, we can prove he pays. He or she pays.
Yeah.
So that's some hacks that we like to do.
That's awesome.
So, yeah.
Well, thank you so much, Jenna. This has been super valuable today. I love that you joined us, and you've been hearing folks from our mortgage expert, Jenna Whitmer, with our title sponsor, First Access Mortgage. So thank you for joining us, Jenna. If you found value in today's episode, click the subscribe button below and share today's episode with somebody that you think might benefit from what Jenna shared with us today. And thank you for listening to the Will Frederick Podcast, where we talk about real estate, wealth building, money, and life.